Hi everyone, welcome to the Sabre Dawson financial reporting update for December. We'll just wait a brief moment while people are still joining. So again, thanks very much for coming along. I'm looking forward to just delivering an overview. I don't expect we'll go much more than an hour. So I think we had a slightly longer meeting or booking. But I expect to be able to work my way through the key changes and what's coming up in the future within that time. I'll make a start. So joining me today is Matt Crouch, and he is one of my fellow partners within the audit team. He's sitting in the background and he's going to answer some questions through the Q&A function. So as we work our way through, if you have questions, please don't hesitate to put them in the Q&A. If they're quite specific, Matt will endeavour to answer them directly within the Q&A, so you'll all be able to see those answers. However, if we get some thematic type questions or some broader questions that are worth addressing at the end of the presentation, we'll go back to those and we'll be able to discuss any of those other questions that are perhaps more broad or and not specific necessarily to a smaller group. So that's the way we'll work the session. So I'll work my way through the content and then we'll do questions at the end. So we'll make a start. So today I want to cover off on a few things. So first of all, it's really just some reminders and talk through some current issues that we're seeing. We'll have a look at related parties and the key changes there, particularly for charities, but it really applies to for-profits as well. I'll then talk about simplified reporting, which is not-for-profit specific area, and then talk about sustainability, which is rapidly coming onto the agenda. And I'll go through some really high-level stuff around sustainability. It will result in you potentially having heaps of questions that I will not know the answers to because of the status of the project, but at least it'll give you some base information and a bit of a starting point for you. So that's the aim today. So kicking off, just starting with some issues or reminders. Just first of all, just remind you that if you're a for-profit and reporting under the Corporations Act, and I'll talk about who large is and what the criteria are for that, but prima facie, if you're required to report to a regulator as a for-profit, special purpose has been gone now for really a couple of years, and so we've got a number of foreign-owned organisations, unlisted publics as well within our client base. So there might be some of you on this call or watching the recording. So if that is the case for you, you no longer have special purpose, which means you need to follow all the requirements of the accounting standards in relation to measuring your transactions and balances, as well as the disclosures typically we see under the simplified disclosure regime. So who is that? So the thresholds have remained relatively the same for large P2I companies, so they are, if you qualify for two of the three criteria set out in that table there. So you are large if your consolidated revenue is greater than 50 million, your gross assets, so total assets, not net assets, so total assets are greater than 25 million, or your number of employees are 100 FTE equivalent, 100 or more. So if you meet two out of those three criteria, you are large. I do note that the tests are on a consolidated basis, so you do need to have an understanding of the consolidation. Do you have any subsidiaries or any special purpose vehicles that would get caught under the consolidation standard? You measure that way. If you're previously grandfathered type organisation, then you would be that exemption has been removed as well under these arrangements. So there is no exemption that exists there. Also in relation to extensions, etc. I just note that ASIC are no longer providing extensions, etc. So it would be your requirements to report and lodge are required to meet the standard sort of 4 months, 5 months / after year end. So they are the current reporting requirements. Just going to pause and be totally unprofessional. Say, Georgia, can you ask the person who's gone into the office next door to be far more quiet, please? Thanks. So moving on from there, so I just want to talk about leases. So lease accounting is a standard that you will have required if you're a reporting entity, so for-profit and required to follow accounting standards, or if you're not-for-profit and following recognition measurement in relation to lease accounting. I just note that if you have leases that are subject to CPI, clearly the CPI rates have been moving quite significantly over the last year and a half, and so your remeasurement of those lease accounting does require a large uplift in your right of use asset and liability, and so that is impacting future profitability as your leases go up, as well as your cash flows. So just a reminder that to be mindful of that as you prepare your forecasts and look at your lease accounting, re-reconciling or remeasuring those where you have a CPI uplift, that we're seeing quite significant adjustments come through for a number of our clients, particularly where they have a large number of typically property sort of based leases. Another issue that we continue to see, and this has been in previous presentations we've done, is that where you have a cloud computing type arrangement, or what's commonly known as software as a service, it's very difficult to meet the definitions of control and therefore capitalise your costs in relation to implementation or modification of software or an intangible that is a cloud computing or software as a service arrangement. So I understand that implementing particularly a new CRM or something like that accounting system can often be quite expensive. Can be a significant cost, upfront costs, and typically these sort of costs are being capitalised. However, a bit over a year and a half ago now, software as a service, the IFRIC decision, so IFRIC is the International Interpretations Committee, in April 21 looked at software as a service and basically determined that things like configuration costs or customization costs, where you as the organisation don't control the underlying code, does not meet those definitions of an intangible asset, and therefore will require expensing going forward. So where you're planning some sort of intangible or some sort of investment into software, changing systems, etc., the test really does hinge on your ability to control underlying code and control the underlying software. And therefore, if you're looking at that, you should be aware that it is quite likely that you'll be required to expense those upfront costs, which may be different to when you previously did software implementations or major software projects. So that's a big one to keep in mind as you carry that out. If you've had some of those this year, would also note that would be a consideration from your auditors or something for you to think about it if you've made an assumption of capitalisation there. One of the other things we're seeing is in a higher interest rate environment, higher inflation environment, we have seen a bit of movement in some building fair value. So if you're carrying your properties at fair value, our experience is we expected to see a bit more decline with vacancy rates, particularly in the city, etc. We actually haven't seen a lot of it, but we would be mindful that some city-based, CBD-based properties have potentially seen a little bit of decline, and so you just need to be mindful of that in relation to in relation to your fair values of assets. And one of the other things we've probably focused on over the last couple of years and seen a little bit of is really just the rigor around asset registers and fixed asset additions. We do note that where you're improving or adding to a property, for example, your buildings, and that you're having an addition that relates to the underlying building. I would note that we often see sort of a 2.5% or 40 years useful life applied to those additions. Really, they should be applied to, or your depreciation rate should align with the remaining life of your building. And so if you, particularly if you have some sort of master plan for your property, or expectation around life of property might be shorter than a 40-year period, you need to align those additions to that underlying period. So it may be that building only has a 10-year life or something like that, and some of the work you've done therefore will only have a 10-year life, and therefore a sort of a 10% depreciation rate would be more applicable. Finally, I do note in and around, again, some of the current interest rate environment, inflation rate environment, and sort of post-COVID, I guess, changes in various clients, that impairment testing has come back onto the agenda. Perhaps it never left, but I would note that if you have goodwill, indefinite life, intangible type assets, so assets that you're not amortizing or depreciating, there is a required impairment test, and that is a need to complete a DCF model. With interest rate increases, we've seen discount rates increase, and so that can impact that discounted cash flow model. So you should be mindful of that. Likewise, other assets, given the economic events that we've seen over the last, I guess, 18 months, it's quite likely that you could have some impairment triggers. So the accounting standard lists out examples of impairment triggers. And so given a number of the economic events that we've seen over the last 12 months, it's quite possible that you've got an impairment trigger, and therefore a calculation might be required, unless you can demonstrate that you've really got significant headroom in and around those assets, even if they are being depreciated, or that you can demonstrate recoverable amount. For example, if your asset base is really property based, and you can demonstrate recoverable amount, then you don't have to go through a full impairment DCF calculation, because it's a recoverable amount / impairment test that gets done there. There's really very few changes in accounting standards. I did just want to highlight one key change, and that's to AASB 101. So this applies equally to for-profits, not-for-profits, in that in effect, there used to be a requirement in relation to is a liability current or non-current, hinged on the definitions, and it wasn't based on expectation. It was really based on legal rights. And the accounting standard said that, used to say, unless you had an unconditional right to defer settlement or payment for more than 12 months, a liability is current. This used to cause issues with annual review type clauses or banking arrangements where their terms and conditions basically said they could amend the terms of the loan or your conditions for repayment, including principal repayment. And a number of banks had those terms. We've seen them reduce their ability to have those terms under some other requirements of fair contract law and things like that. However, they often still existed, particularly for larger loans. The change to the accounting standard has meant that rule has slightly changed, but what's happened is the unconditional requirement has been removed. There's the recognition that under any contract, their rights and obligations, they're not necessarily unconditional. And so what that means, if you previously had issues around sort of review clauses or the terms and conditions of a banking arrangement, particularly where it might be a 3-year banking arrangement, but the bank had right in effect to review or change the principal repayment without sort of a negotiation, then that wasn't an unconditional right. However, now if you have a multi-year facility, even with those types of clauses, presume on the assumption that nothing's you've had no notification from the bank, you've met your other covenants, etc., or other requirements within those banking facilities or agreements, that you will now be able to classify those types of loans as non-current, whereas previously perhaps they might have been forced into the current arrangements. So that's really the core changes to accounting standards and some of the other issues that we think you should be thinking about for the current year. I do just want to move on to another big change, and perhaps it's an issue that's been elevated across multiple sectors. So again, both for-profit and not-for-profit. And that's in relation to related parties. I'll explain a little bit of the background as to why this is a key issue that we're seeing and have been working with a lot of our clients, particularly around the June year ends, that will now impact December year ends. So first of all, I just want to say, if you're preparing general purpose financial reports, so that would be the for-profits who are lodging, and many of our not-for-profit clients or not-for-profits on this call prepare general purpose. And that means you should already be complying with the requirements of the related party standard in relation to disclosure of both key management personnel remuneration and other related party transactions. Why this has become more of an issue is that the ACNC, the Charities Commission, under their requirements, they've now required that any medium or large charity, so a medium charity has more than $500,000 in turnover, a large is greater than 3 million, will be required to report and comply with AASB 124. For 30 June year end, 30 June 2023. So obviously 31 December 2023, you're also now into this requirement. There is some small exceptions from that written in to the regulations by the ACNC. So if your key management personnel remuneration, so that's the remuneration typically of the board and CEO, CFO, COO type, those employees with key strategic and operational control of the entity. If you're a medium charity, you don't have to disclose that aggregated remuneration. Or if you're large and you only had one remunerated key management personnel for the year, then you also are exempt from that disclosure. Again, if you're general purpose, you're not exempt, but if you're special purpose and within those categories, you would exempt. I also note that the ACNC have said comparatives are not required, whereas once we get into a year on from this, the comparatives will remain in. Just a quick note, I do note small charities will be required to report their related party transactions and answer a series of questions in their AOS. As a small charity, you don't have a reporting obligation to the ACNC to lodge your financial reports. We have a number that choose to. If you're choosing to lodge your financial reports, those AASB 124 requirements do get applied. If you're a BRC, which is a basic religious charity, you have no requirement to report or provide financial information within your annual information statement either. So you can remain outside these requirements. However, if you choose to lodge your financial reports with the ACNC, you need to comply with what was listed on the previous slide as well. So what are some of the issues? So that all sounds relatively straightforward. So I just want to walk through, though, why there's some issues around this. So in summary, who are related parties? There's a number of definitions. So first of all, we're just going to talk about people. So the people that are related parties or are related parties because of the people relationship, if you like, any director or member of the board, if you're a committee or whatever, and a close family member or any close family member or anything that or person that has control of the entity. So we more typically see that in a for-profit arrangement, but in a not-for-profit, it is possible that individuals control the entity, a small group of individuals that may be just a couple, for example. So they are related parties. Likewise, any member of the key management personnel or their close family members are related parties, and any entity that they control or jointly control or significant influence. So typically, there may be someone on the board, their spouse, maybe provides some sort of services or owns a company, owns a business, or is a shareholder, a key shareholder in a business that provides services to that client. So maybe it's IT, it could be accounting, they could do cleaning and maintenance, any types of services that would also be a related party. So that'd be a related party, any businesses like that. And then there's a question of, are there any transactions? Then there's the second group of related parties, which really are, I think of the group or the organisational group, if you like. So that would be any parent or subsidiary, typically, or any associate. Sometimes this gets a bit tricky within the not-for-profit context as to who meets those definitions, and it can be quite complex. But think in the for-profit arrangements, usually that's evidenced by way of shareholding or unit holding in a unit trust or something like that. And so it's evidenced by way of equity or ownership interest. In a not-for-profit scenario, it's typically more about ability to control, which maybe is control that the majority of a board, etc., would create a subsidiary type relationship under the accounting standard. If you wish to go back to these slides, I've also included sort of a bit of a visual of that definition. So again, looking across, it looks at those key management personnel, board, senior management, who they and their close family members, entities controlled by them, and then entities within the reporting group. So they are the key related parties that you need to think about. Are there any transactions, or what are the transactions with them? So what sort of transactions could we have is really broad, and typically I'd just say it could be anything, but a common list would be any purchases, sales, receipt of goods, leases of property or other types of leases, loans, guarantees, provision of employees if it's a service-based entity. It could be professional services, anything like that. And it doesn't matter if there's a dollar value attached for that. Either is it a discount or is it for free? That's still a transaction. And so if you step back and think about the board, if the board is not remunerated, so they are volunteers, there's still a transaction going on, being the volunteering of their time to perform a governance function of an organisation, for example. So that's still a related party transaction, but it's for free. And so typically we'd see disclosed within key management personnel, here's the amount that has been paid to key management personnel in total, and often would include within financial reports or recommend that. Then there's also a line that basically explains, well, is the board remunerated or not, and provide a breakdown of that. So contain a disclosure around that. So some of the key issues, and we're seeing a lot of these, particularly in the not-for-profit context, as this whole group of charities who are special purpose reporters now are required to comply with 124 or substantially comply with it. So there's real key issues around making sure, being able to identify who all the related parties are. Often there can be a big board, key management personnel and board members change, and so having an up-to-date understanding of who are their entity, their spouses, entities they control or work for, etc., and have significant influence. And again, like I said, these can get a bit tricky in the not-for-profit context. I do note that just because you have a board member for your entity who is on a board, or your CEO is on a board of another entity, that does not necessarily make those two entities related parties. You need to dig a little bit deeper and understand the relationships beyond that, and think about, is there control over one of those two entities or not, before you jump to the conclusion that they are related parties. So what are some of the issues we've seen? We've looked at things like, if you go back to what is a related party, we've got a number of particularly not-for-profit charity-based clients where key management personnel, so senior management, board members, provide donations to that charity. That is those board members. So let's use the example of a board member. So a board member related party, yes. Is a donation a transaction? Yes. Therefore, you by definition have a related party transaction, which requires disclosure, unless it is not material. And so there's a really key issue around, well, what is materiality, particularly where there's no benefit back to the contributor. And so we've been working with some of our clients around that. I've got some recommendations around that. Similarly, we see often in our client base where perhaps the spouse of the CEO might be employed part-time, particularly we often see it where there's a child or spouse of someone on the board is employed, again, meets the definition of related party transactions, and AASB 124 says amount. And so it's really important that we understand what's material in these transactions, and therefore this will drive the level of disclosure required around these types of really quite sensitive information that is required to be disclosed. And I'll talk through pragmatically where we've landed on some of this. Just jumping back, if you're wishing to understand this further, and particularly if you're a charity, there's some really good ACNC guidance around disclosures of 124 and how the ACNC, who would be a regulator for a number of you on this call, how they've viewed materiality. And what they've said is that often related parties, their definition of materiality is it's about, does it impact decision-making or user understandability? And if not, then that might be not material. There's a few more things, and I'll talk about materiality a little bit more in a sec. The other things that the ACNC are saying, well, what do you need to do? And so we see our clients, they're quite good at conflicts of interest and those sort of maintaining a register of conflict of interest. I do note that related parties are a little bit different. So conflicts of interest is about managing a conflict from a directed duties responsibility. Related parties is about identifying, capturing transactions to ensure you have appropriate disclosure within an accounting standard. And so conflicts of interest may sit at a board level, but transactions, disclosures often sit at a management level. And so having either combined register or a separate register that is able to be seen and monitored by management as well as a board becomes important. So the information, a register and a policy framework, which is what the ACNC and us would recommend, that you have appropriate policies around capturing and identification of related parties, therefore gives you the ability to then monitor and capture the transactions that would require disclosure. So it can be included in conflicts of interest, can be separate, but the idea is to make sure you capture or identify your related parties, capture and identify transactions, hopefully make sure they're appropriately authorised, and then capture for disclosure. So we really think you need a register to do that. The ACNC recommends a register. We've got a template that we've developed that we're happy to provide to any of you on this call. Just give Georgia an email or email back to me. It's a bit of a register. So I've shown a snapshot of a page here, but we talk about, we hopefully step through the various types of related parties to make you capture who they are. I think we've often seen perhaps a narrow understanding of related parties and not enough broad enough depth of thinking around, well, who could be a related party? So we've often picked up scenarios where a child works for or a spouse works for the organisation. They may have been there before the board member even became a board member. Doesn't mean they're not a related party. So it steps you through a series of examples or types of related parties. So this one is, list out all your board members, for example, or members of your governing body to make sure you've captured them. That's the first step that then leads you on to identifying the transactions or potential transactions. So from a practical application point of view, in our belief or thinking, we think the finance team needs to have access to that register. They need to be the ones who are making sure they're capturing and that these transactions are appropriately authorised. It may be that some of these transactions never become a board decision and therefore are not about conflicts of interest. For example, someone's joined the board, but you've had a long-term contract, cleaning contract with an entity that happens to now be a related party. And so there is no, although a conflict might be declared, there's no decision to deal with that conflict of interest, if you like, but there is a related party disclosure requirement. In relation to donations, we think an appropriate response is to think about a level of donations from an individual that could be material. So based on your size of your organisation and those definitions, consider a threshold. So that might be, for example, anything, if a single director was giving more than $50,000 as example, perhaps in a medium-sized organisation, that might be material. And so you simply get directors confirm that they haven't donated amounts across a year greater than that in totality. And so that's how you could deal with that materiality threshold type issue. Likewise, if there's some employee relationships, etc., again, we would say capture the information, and then if we're the auditors or with your auditor, let's have a discussion around how can we pragmatically and sensibly disclose that information without necessarily naming either the director or the employee in that sort of example. And do you really need, is the amount material? Or we've done a number of disclosures where we simply talk about the award that they're paid under or the payroll framework that applies to them just like everyone else. And so that is a way that we've dealt with it quite pragmatically, but it's, again, something that we need to work our way through on a case-by-case basis. So, again, if we're your auditors, someone separate, I think someone else, they'll be asking more questions this year, particularly if this is the first year that 124 applies to you. We'll be asking for a register looking for how you've captured those transactions. The disclosures are your responsibility to identify, and therefore what's the control framework you've developed around that. But we'll be testing some transactions, do some higher level search for what may have been missed. The argument about, oh, that's too sensitive or that's sensitive information, that's confidential. Unfortunately, there's no out under the accounting standards for that. And so it becomes a discussion around how do we, in effect, create a disclosure with you that both meets the requirements as well as considers the sensitivity. So we found that this was quite a big issue from a number of our June year-end clients. It took a little bit of thought. Again, if you're our client, we've updated our questionnaire, made it a bit more comprehensive this year. But if you've got concerns, suggest you get on the front foot with us or your auditor, if it's someone else, around how do I deal with this specific issue and what do we need to do here, and work our way through that with you. So that's the related parties. Again, like I said, a big issue for our June year ends, expected to be so for a number of our December year end clients as well. The next part of the presentation is to give you an update around special purpose reporting and not-for-profit. So like I said earlier in the presentation, it's gone for for-profits, so there's no such thing as special purpose if you lodge with ASIC, etc. For not-for-profits, the concept still exists. However, it is moving towards being removed, and there's clear steps being taken. This is high on the agenda of the AASB, the Accounting Standards Board. There's a not-for-profit advisory panel, which I'm a part of. So we've been, I'm having regular meetings with the AASB, giving feedback on behalf of our clients as opposed to my personal view. So we try to represent our clients as best we can on that. Because we have a number of medium-sized, small to medium-sized not-for-profit clients, and a number of most others on that panel, particularly the larger end technical sort of departments of the large mid-tier. They actually don't deal with sort of these clients in the $500,000 to $3 million client or turnover threshold, and so the AASB actually seeks us out a little bit, and we've tried to give feedback to really represent the sector as best we understand it. So what's being proposed? So the proposals are being developed for sort of that medium level not-for-profit standard, but I do note, as noted on the bottom of this slide, the thresholds have not been set. They will be set by the regulator, being ACNC/Treasury, will set who can use this new framework. It will be a single standard. So it really does combine all the requirements into one standard. That won't be short, but in no way is it just grab sort of the requirements that say currently exist and just cut all the detail out and just dump them into one standard. This is genuinely an attempt to make things a bit simpler and a bit more appropriate for that small to medium-sized not-for-profit. So it will be a single standard. You can opt up to Tier 1 and Tier 2. So Tier 2 is general purpose financial reports under simplified disclosure. Tier 1 is full IFRS compliant general purpose reports, which is done by very few private sector not-for-profits particularly. We expect that they'll issue an exposure draft of this entire single standard in late 24. So that's what AASB is saying, which means you've still got special purpose until at least 2026. But 26, 27, somewhere in there, special purpose is likely to be removed for not-for-profits as well as it has been for for-profits previously. But I won't go through all what's being proposed. They're still in drafting stage. So I've got insight into what are the key changes that are being proposed compared to existing accounting standards. First one is consolidation will be optional. So if there is control, you do have subsidiaries, you get an option as to whether you consolidate or not. And really that means you might not have to assess it, which will be a good outcome for some of you. Leases, many special purpose reporters who don't apply lease accounting under AASB 16. We basically go back to the previous accounting standards where leases, particularly operating these leases, not on the balance sheet. There's proposed simplification for revenue recognition. So those of you who've battled through AASB 15 with us, and particularly if you have lots of grants or a number of revenue streams, this becomes far easier under the proposals, and far easier if you like to get to matching, which is what a lot of our not-for-profit client base likes and wants to do. It's not, the door's not open as wide as they could be, so you'd still, you can't really defer donations and those types of things is the proposal. But where you have a written agreement or instruction from a donor or a supporter or a philanthropic or a grant arrangement, it's far easier for you to then apply revenue on a some sort of systematic basis, which may be matching, it may be over a period, etc. The clear lines and the number of steps to work through under 15 have been greatly simplified. So I think that particularly leases, simplification of revenue recognition are the two things that I think the sector will be really pleased with the proposals on the assumption that what's being proposed gets up. All right, consolidation. Oops, I think I've skipped a slide. So consolidation. So the current standard is an ability to control test. And so that's, as I said, that's quite complex within the not-for-profit space particularly. And so what happened is the AASB has done what's called a post-implementation review. So they're looking at the appendix that gives application to the not-for-profit space of AASB 10, which is the consolidation standard. They're seeking feedback on a review. Now, there's a bit of an oxymoron in this because we have a number of clients, and I'm aware of a lot of organisations that prepare special purpose financial reports that haven't applied consolidation. So we're doing a post-implementation review of something that hasn't been adopted, particularly across certain sectors of the not-for-profit space, particularly in the religious space and those sort of things. So they've sought some feedback on things like determining control, the application of what's called variable returns, which was one of the limbs in control, but really it was made almost not applicable under the AASB 10 for not-for-profits, in that if you're advancing your purpose at all, you're basically deemed to have returns and therefore meet one of the limbs of the test. So we've put in submission and sought out a number of you specifically to discuss this requirement. Obviously, we think it's a big issue, both because, like I said before, a number of reporters haven't adopted. The standard really doesn't take into account different charitable purpose. So where you've got one purpose in one charity, a different charitable purpose, perhaps a different tax status, or within another. Should they be put together or not in a consolidated set? Should you be required to or not? And the issues around even the ability to access that financial information between two entities, etc. So we did quite a detailed submission. I see the AASB, members of the AASB board and some of the staff at somewhat regular intervals. I continue to advocate for those of you on the call who are probably keen to know what's going on. I continue to advocate that this is a really big issue and continue to state our view that an alternative model is required that really does consider the primary users, considers what is genuine practical control, rather than some of the historical constitutions, etc., that would indicate control, but it's really not being exercised, and there's no real practical control. And we think that variable returns focus should be narrowed to really look at financial returns, with an idea that if you've genuinely got the same set of users who would think that these organisations act so closely that they should be reported as a group. If that was the case, that the consolidation probably still remains, but where the user group are totally separate and the putting together of two different organisations actually doesn't benefit either of those groups, we think there's a different model required. So where's that at? Submissions have been closed for ages. As far as I can tell, the AASB really hasn't considered those submissions in any form of detail. They will need to do it as part of the Tier 3 considerations. They're slowly working their way through some other post-implementation reviews as well. So we'll continue to raise the issue, continue to advocate, and hopefully help get to a sensible and practical solution on consolidation in the NFP space, particularly before special purpose gets removed. So that's where that one's at. The last thing I want to talk about is sustainable reporting. And for those of you who've been coming to these sort of sessions every 6 months, or hopefully every year. Every 6 months is probably too much for you to come unless you love this stuff. You probably haven't seen me talk about sustainability reporting before. It's been a topic that's been, I guess, out there, but without regulation, disparate levels and types of reporting. No one was doing the same thing, and it was all really quite voluntary in this space, other than for the very large end of town, which had to report under what's called the Engers Act, and some of those types of reporting. outside of that, voluntary and very, very different entity to entity. So there was no comparability. So sustainability reporting is a big elephant that's just entered the room. I wanted to have a slide where this sort of elephant was smashing through a wall or something, but I couldn't find one. But it's definitely coming, and it's coming quickly. So what's happened? So sustainability reporting in November 21, the International Sustainability Standards Board was established. In Feb 2022, the Australian Accounting Standards Board adds sustainability to its agenda. In effect, what is it working on? In June 23, the International Board released what's called S1 and S2. So these are the first standards on sustainability reporting released internationally, and now there's three parties sort of involved in this in the Australian landscape. Treasury, who writes Treasury write the legislation in Australia, federal legislation. So Treasury has started a consultation process. The AASB issuing exposure drafts that align with S1 and S2. However, they've got a narrower scope. And under the Treasury consultation, proposed effective date for the first entities reporting in Australia. Don't fall off your chair quite yet. Let me get to some slides which tell you who the first entities are. But the proposal is that from 1 July 2024, the first entities in Australia, so this is a really large end, start to report under what gets in effect finalised, the equivalence of S1, S2 in Australia. And so there's three parties involved, as I said, in Australia. So there's Treasury writing the Act. The AASB, so the Accounting Standards Board, will write the requirements. Treasury will write an act that says, here's what's required, and referred to the AASB standards. And the AUASB, which is the Auditing Standards Board, will write the assurance standards around what sort of audit/review level of assurance that you require across the various requirements under these standards. So these three parties are going flat out, trying to move this very quickly. I was in a meeting last week with someone who had been at the AASB, a technical director of the AASB for a long period of time, no longer there, but had been sort of this was her career for the best part of 15, 20 years around this technical accounting standards space. Said, in her view, the AASB, the accounting standards, both internationally and Australia, have never been on in a process that has happened so fast. And so it's really becoming rapidly. There's issues when that happens. So hence Lightning McQueen in the picture. So sustainability reporting, what are the key proposals in the Treasury consultation? So hear this, they're proposals and Treasury is consulting. Okay, so these are not laws, they're not enacted yet, but here's what Treasury is working towards. So what are they saying? It's going to include, so who is the majority of Corps Act entities who report under Chapter 2M. If you think back to when I talked about special purpose and said, who's a large proprietary limited entity, and what are those thresholds? Anyone who's a large proprietary limited entity, a public company reporting under the Corps Act, the proposal is that they will be included in sustainability reporting. AC&C charities, here you think, hang on, do I report under Chapter 2M of the Corps Act if I'm a company law by guarantee? The answer is no, but Treasury consultation hasn't addressed yet what happens with AC&C charities of that size. So not just large being the $3 million threshold. I don't think there's a proposal that it will push down to that level, but the 50 million turnover threshold, etc., I'm uncertain. The requirements are being drafted in a sector neutrality concept. So that means both for for-profits, not-for-profits, etc. And so there is a possibility ACNC charities will get caught. Likewise, the way the consultation currently exists, if you're a non-ACNC charity, think sporting organisations, those sort of entities. So they're not an ACNC charity, but still a company limited guarantee, not for profit. If you're a peak body, that's again not an ACNC charity, and you're within those thresholds, the way the current drafting would look is that you would be required to report under this under sustainability reporting. So that's who. The second bit is broadly what. And the Australian Treasury is proposing that what we're going to do in Australia is not full sustainability reporting as drafted under S1. If you think about sustainability, that can include things beyond climate. So we're not just talking, sustainability is not just climate change, obviously. It can be diversity within, so I've forgotten the word, within various, so diversity on the barrier reef or something, those sort of things, ecological diversity, other sustainability might be waste, all those types of things are sustainability, whereas we are limiting in Australia to climate-related disclosures. So think greenhouse gas emissions and those types of climate-related disclosures and global warming type issues. So that's what. So we're doing a narrower scope implementation in Australia than what's been proposed out of the ISSB. Where it'll be included within your financial report, with references out typically, and mainly sit within directors' reports. The directors' reports are mandatory under the Corps Act, Chapter 2M of the Corps Act. Will assurance be required? Yes. So there's a proposal for assurance audit / other levels of assurance to be required. And as it sits within this in your financial report, directors' report, the timeframes for reporting, the periods for reporting will be the same timing as your annual report or annual financial report. All right. So that's the who, what sort of slide. So the who, let's break the who down a bit further. So there's some categories of this, of when reporting will come in. So where I said 1 July 24, first year reporting is for that top level. So you've got, if you meet 2 or more of the thresholds, so they've taken this 2 or more of the 3 thresholds concept. So where you have revenue of $500,000 or assets of more than $1 billion. I need to check that slide. I'm not sure if I've got those last 2 categories around the wrong way, actually. But where you're a significant entity, up there, you have early reporting thresholds or reporting requirements. Then there's a medium tier as disclosed on that on those slides, and then there's a final, the final one, the third one. Those criteria are absolutely correct. Let me check the top 2, but where you have those, this is your timing for implementation of sustainability reporting under the Treasury consultation proposal. So again, not law yet, but proposed. The assurance trails behind. So where in year 1, there's limited assurance, and it's going to be limited to what's called Scope 1 and Scope 2 emissions. I will explain what they are in a second at a very high level. And then some reasonable assurance, which is audit level assurance, coming in on governance. So in year 1, that's what will be required. And as you work across to year 2, 3, and 4, in effect, the level of assurance and breadth of assurance becomes larger over a period of time. All right, so that's how assurance will work in and across the proposed reporting. Now, I need a full hour presentation to go through this, and I wouldn't be the best person to do it. So I'm just going to just talk to you briefly about what's required to be disclosed. And there's broken up into, in effect, 4 categories, pillars. So the first one is around governance. So what are you doing at a governance level around sustainability, particularly around climate change impacts and greenhouse gas, or your impacts within that? What is the governance responsibility? So what policies do you have? Do you have a separate, have you set up a separate committee, etc.? So they're the type of governance requirements. If I flick over to risk management, then it's, well, how do a risk assessment. So the requirement is do a risk assessment. This will be both at an entity level around, well, how does climate change, greenhouse gas emissions, etc., impact me as an organisation? So, for example, if you're an agricultural based industry in and you had marginal farming property or something like that, climate change impact on that, high risk in that land may be unviable for its current use, etc. So there's those types of risks. As well as which are entity specific around your financials, as well as other types of risk around reputation, your other types of greenhouse gas emission, etc. Those types of risks. So if you're a steel producer, for example, burning coal to produce your steel, that's, you've got a different series of risks. Then if we flick across and go, well, then there's the third one is around strategy. So what's your strategy, particularly around dealing with those risks and managing your sustainability reporting, as well as your sustainability-based goals. So what is your strategy or plan around this? And there's disclosure of that. So that can be targets, include things like targets, forecasts. And then there's reporting around your metrics and targets, which is your actual emissions, if you like, primarily. So what does metrics and targets look like? So again, this might be a little bit hard for you to see, but there's scope 1 emissions, and really they're the emissions from your facilities as an entity and your direct emissions or direct emissions of greenhouse gas type emissions. Your scope 2 emissions would primarily be electricity, in effect. So you're not, in effect, releasing greenhouse gas on those scope 2, but you're using electricity where greenhouse gases may or may not have been emitted. And then there's the scope 3 emissions, and these are really broad. So these are both your input based activities as well as your output. So both your downstream, so it's called downstream, upstream type activities that have a greenhouse gas consequence, if you like. So that sounds very big. So what does that even look like? And I can hear that, how do I measure that question? So I just want to give you a little bit of example. So there's a number of, particularly the really large and professional services firms, so accounting firms, etc., who are already doing consulting at a fairly high price into this sustainability reporting space. They're working with the very large and listeds, etc. They're starting to do these reports themselves, publicly available. So what sits within the various categories? So if you think about a professional services firm, they might have buildings. They probably don't have many company vehicles, etc. So their main scope 1 emissions are really refrigerants and those sort of things within their properties. Their scope 2 emissions is really just electricity. Gas would probably sit up in, if you had natural gas or something like that as well. Heating or something like that, that would probably sit up in your scope 1 as well. So those ones are perhaps not too difficult. Scope 3, their big ones were employee travel to and from work, business travel, a little bit on waste generated. There's some capital goods, but it's mainly IT and purchased goods and services. There's actually 15 categories to break down to get some standardized reporting. And how they measure those is they either obtain data from suppliers or key suppliers, or there's industry data, if you like, around various, what are the average greenhouse gas emissions per dollar spent on particular type of sector, for example, advertising or something like that. Interestingly, they often explain what the methodology they've used. So employee travel to and from work, they did surveys of that. How do you come to work? Is it train, public transport? How far? What sort of car you got? That sort of thing to help them develop and work out greenhouse gas. So again, I hear this sort of stuff and go, how would anyone measure this? But I am reminded that there are organisations out there reporting this already. Greenhouse gas legislation has been out for multiple years. So the large end of town particularly large emitters have been reporting greenhouse gas emissions for multiple years now. And there's various accounting and systems being IT type systems, which work a bit like an accounting system, being developed to enable the recording, accounting for greenhouse gas emissions. We also hear a lot of organisations coming out and saying, well, I'm going to be greenhouse gas neutral. Or I'm greenhouse gas positive in the agricultural sector. So they're all basing those claims based on methodologies of measurement. So definitely out there, but me, like probably a number of people on this call are saying, wow, I've got a lot to learn here. So where to from here? I would say if you're just starting out, think about your scope 1, scope 2. These are things that you will have information on likely, and just start your greenhouse gas emissions journey with those ones. Start to understand what they might be, what your maybe formalise a little bit more, what your governance and your risks and your strategy might look like, and start to work your way through, I guess, preparing for that. Again, if you're small, you have multiple years and you're going to have a number of the larger end examples to help you as you go on that journey. So that's probably what I'd say as far as where to start goes. In relation to scope 3, again, I think we all have a lot to learn there, but the idea if this pushes down to the levels under the Treasury consultation, this will need to become broader based information, more publicly available and more well understood across the sector. There simply isn't enough experts in this field to enable this detailed reporting and analysis to be done down at the level that's being proposed. It will need to get disseminated, and so there will be time and help available around that. I'm sure you've all got a lot of questions. I'm hoping Matt's answering them. Again, I'm probably not going to answer detailed questions on sustainability reporting because a lot of them will be, I just don't know yet. However, if you're having a mild panic attack or you want to know more and go, actually, no, from a brand perspective, I'm likely to be in those thresholds, a brand perspective, I want to understand this. I would suggest the next step of your understanding, if you're really starting at a base level, go and read that. So this is a report put out by the AICD aimed at directors. What questions should you be asking? What are the core information you should be understanding as you work towards? So they're thinking of the, written a bit with the larger end in town, but it does have scalability within it. So I've had a read of this. I've got a number of other things are on my list to read around how do you measure some of these things, and there's guidelines out there around this stuff, and I think they'll become developed and more clear. But that's maybe an example of a first step. I'm sure if you're one of the accountants in the room, member of a professional body, they're already starting to put out sessions, training on this. That's some of it's free and accessible. So step back from your, oh my gosh, how am I going to do this? And start working your way step by step through, and I'm sure we'll work our way through it together, either as a preparer or as assurance provider. We're going to work our way through with you on some of this stuff. So that's really it for sustainability. So I'll probably just end my show. Hopefully I'm going to be back on the screen. There we go. So if there's any, I don't know, I might pass to Matt and just see if there's any questions around that have been thematic or anything else that Matt wanted to add.
Yeah, thanks, Jeff. Great presentation. There was a question on sustainability reporting, and I know you said you didn't want to answer specific questions, but let me read it out. Disclosures on sustainability reporting. Is there a standard units of measurement, setting up metrics and targets, more importantly, and how to evaluate them, and acceptable uniform methodologies, guidelines for informed and reasonable disclosure purposes? For example, HR advocating in a carpooling regime, would that get brownie points on FS disclosures?
So two questions. So yes, there are units of measure which in effect come back to the level of greenhouse gas emissions. So, but it's really going to be CO2, and then a conversion over to CO2 if there's other like methane gets converted over to a CO2 equivalent type, is my understanding. And so that will give clear unit of measure benchmark. Around the various categories and types of benchmarks, etc. They are out there, but there is a lot of development and clarity sought around that. I think over time, organisations will push down and ask their suppliers what is it and get specific information, whereas a lot of it's being built on industry data at the moment, which is around, but it's probably at an international level more and perhaps not as specific and as disaggregated as we might like it going forward. But I think again it's going to advance rapidly.
Yeah. You questioned your slides on the thresholds for the three groups.
Revenue
they are correct.
Yeah. They've switched revenue, and revenue is typically the larger one and sort of assets are smaller, but in that 1 and 2, it's switched the other way around assets, etc. So there you go. I don't have to remember my slides.
On basic religious charities, so if the BRC voluntary lodges their accounts with ACNC and it's not compliant with related parties or something like that, can they remove them, amend them, get them fixed up?
So I think there's probably little implication of that. So if you've lodged previously, you would probably just leave them there. But I think you've got a decision. Do you want to, in effect, comply? When you lodge, you're basically saying you're complying with the ACNC Act in and around that. And so I think your decisions going forward is to say, are we going to lodge, continue to lodge and comply, or are we going to not lodge? Really is the question for you. But yeah, my personal view is, yeah, I probably wouldn't go back and worry about historic lodgement on the ACNC.
There seems to be much confusion in many small accounting firms in the area of special purpose reporting for small private companies in respect to disclosure requirements. Just want to touch on that a bit. Yeah,
so when I said there's no special purpose for for-profits, there's no special purpose for for-profits who have to lodge with ASIC, in effect. So if you're below those large thresholds, you're a small for-profit, you have no reporting obligation, and therefore you may choose to do reports for a bank, for internal purposes, for some other purpose. In that case, you can do what you like, and therefore if you do a set of accounts that sort of look like a set of accounts prepared in accordance with accounting standards, they might still be called special purpose. But so that's I guess the nuance there that maybe I didn't disclose. I was really talking about those who are required to report under the Corps Act. And just note that the thresholds for companies limited by guarantee that are non-ACNC charities are different. So that you're at 250, you're still at 250 for medium, 1 million for large. So although you're not for profit there, but again, those thresholds will change for you. So am I for profit or not for profit under the Corps Act? If you're not a charity, what is my threshold then? Therefore, can I still prepare special purpose or not? Is you need to work through.
There's no other questions. Maybe a minute or two to people to put in their last questions. Just to check. Yeah, there's no other questions.
All right. Thanks, Matt, for moderating that. It's really tricky for me to sort of see questions and not get distracted by them as I try and speak through my slides. So thanks to Matt. Thank you all for attending. If there are things you specifically want to ask, please don't hesitate to reach out to your the manager or your partner on your engagement, or that you normally work with. And otherwise, thanks very much. I'm looking forward to the sustainability journey with you all over the next few years. Yeah, wishing you all, on behalf of us, if we don't see you, hopefully we'll see some of you at interim visits in the new year. But otherwise, certainly wish you all a Merry Christmas and a safe and happy new year, etc. And hope you have a good afternoon. So thanks again for joining us, and look forward to seeing you all again soon. Have a good day.